Welcome to Fintech Impact. This podcast is an exploration of the financial technology world, interviewing different fintech entrepreneurs about what they do, their story, and what their impact is on consumers, incumbents, and the industry as a whole. Here's your host, award-winning financial planner, university lecturer, and writer, Jason Pereira.
Welcome to Fintech Impact. I'm your host, Jason Pereira. Today on the show, I'm going to flip the tables a bit. I will actually be the guest. My good friend and fellow financial advisor, Guy Anderson, is going to be the guest host. So really today's goal is to explain some of the acronyms and nomenclature and tech speak that we keep on using on this show. Several people have emailed me, asking me questions about what was this you said specifically and what is that? So we're going to try to get away with that. And this is really, I entitled this Fintech 101. So this is explaining a lot of the terminology, and hopefully you enjoy it and hopefully it builds your understanding a little bit better. So with that, here's me and Guy. Hello, Guy.
Hey, Jason.
Thanks for coming in.
Thanks for having me.
Okay, well, you're hosting today, so you get to turn the mic over to you.
Well, yeah, I'm happy to do it. So first of all, before we get going, I want to congratulate you on your success.
Well, thank you.
And I don't know how you plan on measuring success, Jason, but if your objective was to reach people like myself who like podcasts and are in the financial services industry and like technology, you've hit your mark. And so if your target audience was one, I'm your guy.
Great. You can be my sponsor. Okay. Yes. Well, thank you very much. It's been a lot of good feedback thus far. If anyone wants to reach out, feel free to email me at jason@fintechimpact.co because it's always interesting to hear from you. And I've had a lot of good conversations since this started.
Yeah, you really have. You've had a lot of good conversations with Plan Plus and Lending Loop and others. Yeah. And I've enjoyed all your podcasts. But rather than spending time on the past, let's jump right into it. So my understanding is we'd like to cut through some of the jargon here on financial terminology and such. Yeah. So, Jason.
Sorry, it's funny because I remember back in university, I had an engineering buddy who said, what is it with you people in business having to create acronyms out of everything? And I think that the worst part of business that does that is definitely finance. And you throw technology in there and finance, and we're rife with language that people just don't understand.
Absolutely. It can be very confusing. So without delaying this any further, Jason, what does API stand for? I hear it all the time.
God, that's a term I drop in basically every conversation I have. So API is basically an acronym for Application Protocol Interface. And really what that is a way or a language or rules that basically a company puts out there for something else to talk to its program. So simply, if anyone's ever been online and said, hey, you can tie in this program to something else and have them talk to each other, they talk through APIs. So basically, it's like someone saying, here's the rule book for how you access this data. And let's say, for example, I want to connect my calendar system to my CRM, right? Very simple. At least it looks very simple. Someone has to come in the middle there and basically create a code that basically will say, okay, well, this person's speaking French, this person's speaking German. How do we get French and German to equal the same thing, right? And that's how it works. And you can typically find these things. I mean, the entire app store and anywhere is basically designed to work like an API, just basically a series of APIs. And in addition to that, I mean, what's interesting is this is what's really enabled us to be able to share information between platforms. Before, you used to have these silos where data was stuck and you're like, oh, I wish I could get it from here into Excel or here into there. Mm-hmm. Well, now with APIs, it's becoming a much more standard, common thing to have and offer. So it's pretty accessible. And there's even companies out there, one company specifically called Zapier. All they do is create APIs for companies that don't even ask for it. So for example, you take a picture and you post it to Facebook. Well, they have an API where it will download that and put it in your Google Drive as a backup automatically, right? So all this stuff can be happening in the background without you thinking about it.
Fantastic. So the average investor or financial person, how would they experience APIs?
That's a great question. So the reason why that's important is because, again, let's talk about the disparate systems we had before. CRM, financial planning, rebalancing software, more so in the US than Canada, just any number of things, including reporting. Like these things couldn't talk to each other before. And now they can, right? Now it is possible for you to have integration whereby you put data in one time as opposed to repeating it over and over again, right? And the number of times I've heard my biggest pain in the butt is having to retype my client data in from here to here to here. Well, that doesn't have to be the way anymore, right? If the software is architected properly and someone basically writes the code in between, then you can literally have all that data flow and be accessible in multiple places.
Great. So it makes our lives a lot easier then.
Absolutely. The future is definitely a more integrated one, right? It's a more modular one in that you can go to different vendors for different things, but APIs allow integration across different modules.
So the next one I wanted to ask you about is, and I think Amazon fits in here somewhere.
Yeah.
What does AWS stand for?
Yeah. So back in the day when you had a tech company, what you would do is one of the first things you would do is you buy servers, right? And that was expensive because it was a lot of equipment. And you park it in the corner and you do your stuff on the servers. And you basically open up to the internet to let it out to the rest of the world. What Amazon did several years ago was they basically realized that there was a need for people to outsource this. Now, outsourcing companies already existed where you could just go online and hire server space from somewhere else and work remotely. But it wasn't great. What Amazon did was they started a division called AWS, Amazon Web Services. And they basically built a system that was very modular, very scalable, so that any company can come on and for peanuts, literally cents per day, start to code their program, right? Now, that's when you're starting. When you start getting traffic, then they start charging you, right? So what happened is that they basically did this because they needed the systems for themselves. And they said, why not just basically create a best-in-class thing that we offer to the rest of the world and use our cost efficiencies to drive the cost down? So when you're Amazon, you're a large buyer of servers, and you also have talented technicians who basically can focus on nothing but this. So basically what this did was this created an incredible ecosystem. It created a very, very low cost way for companies to get started. They didn't have to buy equipment, right? If you had a laptop, you could start coding if you were a coder. So a lot of companies are powered by AWS and people have no idea. Netflix got rid of their own servers and pushed all their content onto AWS. Companies like Dropbox and Box.com, places like that, they basically use AWS as a backbone. Apple uses AWS for a lot of stuff, I believe, too. Now, they're not the only player in town. Microsoft very much is on these web services campaigns as well. So Azure is their product, and Google has one too. And basically, those are the big three. But AWS is the largest one. I think I once saw a survey that said something between 40 to 60% of all cloud services offered on the internet are offered through AWS.
That's fascinating. And I imagine combined with IBM and the other, it's more like 70 or 80%.
Well, I'm not even sure how much of a player IBM is in this space. I don't think they are. They got out of that. They may provide some of the infrastructure and technology, but in terms of actually offering it, I mean, you have Amazon and all three of these companies going out and creating server farms in the middle of nowhere that have power. And basically, like, these things are enormous, like multi-football fields long, high security so no one can get into them. And basically, they host data from any number of thousands of companies. And the thing that's insane is this is actually the most profitable division of Amazon by a long shot. The majority of their profit. I mean, Amazon chooses to win the report profit, but one thing's for certain: if you break it down division by division, AWS is basically the crown jewel right now in terms of profitability. And frankly, the way to look at it really, and this was described by a commentator named Ben Thompson, who termed what he calls the Amazon tax. AWS is basically a tax on the entire internet when you think about it, right? Because they're getting a slice of every company's profitability who basically chooses to host on them, right? And they're the largest player and they control the largest amount of cloud space. Man, it's a big number. And you have to think about the cost efficiencies. If you're a tech company, you're not going to get the same kind of cost efficiencies Amazon is, right? The only companies who do their own type of thing, like Salesforce is the one that comes to mind. Salesforce is a behemoth, right? So do they have their own dedicated server farms, especially for confidentiality? Absolutely they do. But few companies can afford to do that.
So the next one that comes to mind, and I've been hearing a lot more about it recently, but GDPR, Global Data Protection Rights. So here's the thing. The Europeans like regulation? Yes.
Yeah, you had to sign 5 forms to take the bus over there. And, it's an interesting contrast to what happens in North America in terms of lack of regulation and slow regulation. So GDPR, basically the European Union got together and said, you know what? We don't like the fact that all these tech companies have access to all this personal data and they're monetizing it and making money off of this. And okay, that's fine. And we're getting stuff in return, but what are our rights in this? Like, where is the consumer protected? And that's the good thing about Europe is that Europe typically looks at it from a consumer first standpoint, as opposed to the North American attitude of looking at it from a business first standpoint. So they came out with these laws that basically cover some of the stuff that you would normally think, right? So some of the stuff like essentially, one of the things that's interesting is that they now have enforced their rules across borders, which before tech companies could play hide and seek and basically hide technology across, it went from a European country to another European country so that other authorities couldn't get to it. Can't do that in Europe anymore. They also want data that's for European citizens hosted in Europe, so that's under their law. So that's also being passed. Penalties, the need for consent. Companies can't ask for everything under the sun unless there's a reason for it, right? So there's limitations on what they can ask for. There's limitations on how long they can hold that data. But some of the more important ones that are quite interesting, and the two biggest ones are, quite frankly, the right to be forgotten, right? So the first one is literally, if you want Google to wipe out everything that they have on you, you have that right. I mean, it's the internet. It's hard to accomplish that because someone says they don't like me on their blog post, right? I can't enforce them to take it down without getting lawyers involved. And even so, what's the condition? But the right to be forgotten is one that seems to be one that is resonating. So if you don't like the fact that Facebook's got history going back on you for so long, Google's got that going back on you for so long, you can request that they wipe everything clean. You have a blank slate again. So that's the first one. The second one that's really interesting, and this one is an interesting Pandora's box of opportunity, is data portability. So the way they specifically word it is they basically want people to have the right to transfer data in a commonly used and machine readable format between the data holder, so the company that's collected it, and anyone that you consent to. So before, let's use banks, for example, banks in Canada in particular, who always are the bane of my existence and my enemy in this, in this podcast. But essentially, you look at your banking history. You can pull down banking history for 12 to 18 months. You want anything further than that? Good luck. They're going to charge you for it, right? But not only that, so it's available. It's available to me. But it's difficult for computer technology to get to it. Why? Because they have yet to build an API in this country that allows any company, anyone access to transactional data, right? They say it's for security purposes. I say it's for creating a moat around our data, which we have a right to. But essentially, they make it difficult. And they make it difficult, too, because they basically try to prevent data aggregators, the likes of Mint.com, Yodlee, which powers a lot of data aggregators, and Quovo, who's going to be a guest on this show. They basically try to make it difficult for these people to scrape the data. And they will say things like, oh, well, let's say, or claim things like, if you basically scrape data off of this site and give your bank card information to any other online source, you're voiding your fraud protection. Well, here's the problem with that. They will then turn around and offer their own data aggregator. So it's okay for them to collect your data from other banks. But if someone collects the data from the bank from that bank, oh no, sorry, your fraud protection is gone. That has not been challenged in court yet, but I've been told by several lawyers that will die a very quick death in court because you can't take both positions. So GDPR is interesting because banks would be forced to give that data. So now let's think about all the permutations. And when Sean Brayman from Plan Plus was here, we started brainstorming some of them. And my God, like you think about the fact, like let's say you have a jewelry shop, for example, and someone comes in and can't quite afford it. They would want to buy it on a credit card. Well, there's nothing stopping you from having access to an app that they can grant you authorization to view their credit profile on, giving you a credit score, and you could become the bank to them. You could basically finance the loan because you can score them as good as any bank now because you have access to all their data.
So that has ramifications for some of the companies that you've had on here, like a Lending Loop or something like that as well. Then.
Yeah, I mean, absolutely. I mean, to actually, if anything, I think Lending Loop becomes kind of the marketplace for it, right? So they basically, as we heard in the show, they use a lot of machine learning and some parallel processing to basically find out, to score the risk tolerance for the borrowers, right? And thus far, they've actually overestimated the risk. Well, the more data they have, the more likely they are to be able to put together a profile. One of the most fascinating cases of data aggregation and use of this information came out of Africa. And I can't remember the woman's name. I got to look it up, but I'm looking up as we speak. But there's a TED Talk on it. And basically what she did was, the problem with the unbanked in Africa is how do you get information to assess risk, right? So what they did was they created an app that would scan your Android phone. Now in Africa, everything's an Android phone because Apple's too expensive. Shivani Suraya, I'm butchering her name. Shivani Suraya, incredible TED Talk. Anyway, so they would scan your Android phone and look at any number of factors that you wouldn't necessarily think had anything to do with lending. How often did you call your mom? Who are the top 10 people in your most called list? How often do you browse pornography, right? Like what are the tone of messages in your email? They would scan all of that and use that to create a risk score. And they've collected so much data that they can literally say, well, you know what? You may think that it's good that the guy calls his dad on a regular basis, but if it correlates with these two things as well, then he's a bad lending risk. Like they've actually framed all that, and they've been able to create risk profiling around that. So in North America, it is an interesting thing about Africa. The lack of data rights there have opened up the ability to do this, right? So that's kind of interesting. Now, what GDPR is trying to do is move to a world where that sort of data mining is possible, but only with the consent of the individual. And on top of that, no more silos, right? You can't have data that basically is not accessible from different places. One of the early guests on this show was a company called Honest, right? Honest does, one of the key things they do is data aggregation. One of the big trends I think that's going to come out of this is further regulation around the world that looks like GDPR, but the advent of what I call personal data lockers. So the ability to basically, if you have all this data in like 3 different banks, an insurance company, whatever it is, that's fine that you can transfer it between companies, but you're going to need a centralized repository for putting it yourself, right? And I think we're going to see the advent of a number of companies that start doing that. And I think Honest is very early to the show there.
So do you think GDPR, similar regulation will go into the States given what happened to Microsoft and the 71 million users that got their data hacked?
Oh, well, you think Microsoft or Facebook?
Did I say
Microsoft? Oh, they're blue companies. So Facebook, yeah. So I think the U.S. is a challenge because you say what you will, there's a lot of corporate influence there. And I think because of that, it's harder to get those things passed. But you listen to people in the technology spheres, and they're talking about like the need for like constitutional amendments to protect privacy rights. And I think that is absolutely something that needs to be looked at. I don't know what politicians are going to have the appetite for that because of the money they take from different collectors. But the one thing that's for sure is the U.S. is not going to be the last country standing on this. So as these data rights issues spread around the world, and Europe has led the way on that, I think you're going to see, China's never going to pass anything like that. They're never going to, right? Yeah. But I think you're going to see pressure mount elsewhere. And let's face it, that Facebook hack was big. The Equifax hack was big.
It was big. Yeah.
And they were both dumb. They were both really stupid engineering problems. One was just a dumb password. The reality is that this is going to keep on happening. Right. And unless we have rights to protect ourselves and the right to eliminate anything going forward or anything on these places going forward, it's going to be a problem. So we are sorely over. Basically, we're waiting far too long in North America for this to take place. But the good thing is we have to see how the European experiment happens, and it'll be interesting to see how that works.
Well, it's interesting you say about the right to your own information and the right to wipe your slate clean, because I'm going back a couple of years ago, but there was a very controversial hack. You might remember Ashley Madison.
Oh, yeah. Where they found out there was all 2 women on Ashley Madison.
Exactly.
That was fun.
But there's a lot of people there that thought their data was erased, but it wasn't. And ultimately, their names were left on lists.
Oh, and the lists that were public. You could look up how many people. I actually scrolled through that list to see where everybody worked. And there was a lot of people working at certain accounting firms and tech companies that I'm not going to mention. But that was just out of curiosity. But yeah, that was exactly this sort of thing is going to happen. The reality is kids are taught today, and unfortunately they don't listen, that whatever you put online, consider it there forever, right? Like the stupid things you do in university could prevent you from getting the job you want because, oh, look, he's doing a keg stag on a beer bong and like just any number of things, right? So your reputation can be destroyed very quickly. You can destroy your own reputation very quickly online.
Absolutely. Yeah. Yes. As parents of young kids, I'm sure that's a fear we both have.
That resonates, yeah.
So next one I had here was platforms. Platforms mean a lot of different things, but tell me what that means in this context.
That's where you have a concert. No. So basically, that term is bandied around a lot in the Valley, and Facebook likes to consider themselves a platform, and there's a lot of debate about that. The term platform really is a technological system that allows other people to build other functions over top of it. So the most common example for this is quite simply an operating system, right? Microsoft built Windows, Apple built iOS, but all the other programs that basically that can work on top of them, say, for example, Adobe Acrobat or Photoshop, Word, all that, those are not platforms. Those are functions. Those are applications, right? And without the technology of a platform, think about what would have to happen for you to work in Word. The coder would have to write everything down from the base software of how to operate the RAM and the ROM and the CPU and all of that. They would literally have to copy that and do that in every program, right? They'd have to recreate that. So remember when you were a kid and you get these little single-purpose computers that would do math, right? Like that's not a platform. That was an application that went all the way down the channel, right? A platform allowed in that case developers to not worry about the operations of the computer. You had instructions to tell a computer how to do something, but all the stuff on how the computer worked with the hardware was behind it. So a platform is something that lets people build over top of it. And at AWS, which we just talked about, is a perfect example. They've created an online platform for the development of other technologies, right? Operating systems. Those are the most common ones. But everyone seems to want to build a platform. Why? Because platforms are very profitable and very, very powerful. Why? Because, hey, you're basically taxing everything that uses you. And frankly, it's also something that is basically everybody's going to try for, but it requires scale. That's where a lot of these things that call themselves platforms necessarily aren't. The best definition of a platform is when you try to define what is a platform and what isn't. Bill Gates said it best one time. I think he said something to the effect of, someone else called what they did a platform. It's like, that's nonsense. You're not a platform. A platform is something that exists, something where the total net value of what is created on top of you exceeds the value that you create.
Okay.
Right? So think of the phone systems, for example. Telephones are a platform. Think about all the business that transacts over phone calls.
Fascinating. Yeah.
Exactly.
Yeah.
Internet, same basic principle. The internet's a platform.
All right. So next one, we're getting into some deep stuff here. So tell your audience and tell me what your thoughts are on AI and machine learning in today's world.
In today's world, and then we can get into fintech too. So AI, artificial intelligence, we're not talking Skynet yet here or cyborgs walking around, or not cyborgs, but robots walking around. Yeah. If you saw the Google I.O. demo, we're not that far away. Yeah. So the reality is it's a combination of a number of technologies, right? So the entire idea with artificial intelligence is to create something that would essentially pretty much act or compute faster or as fast as human beings. So right now we have in most places what we call narrow AI. So narrow AI, computers are really good. It's a lot of work to teach an AI. So it's hard to teach them what we call everything or general purpose AI. So general purpose AI is a concept of, data on Star Trek, whatever it is, right? He can do anything. But we have AI everywhere now, right? We have AI from Siri, no matter how good or bad she is. She can book reminders, all that sort of thing. So that's a narrow AI, some things that they can do. The AI on a Tesla, it can drive itself more or less, right? And again, that's very narrow because it can do one thing. Ask the Tesla to cook a meal, it's not going to do that, right? So what we have there is the very first generation. So narrow AI is not easy, but it's the easier form of AI. But it's really a combination of a number of technologies, right? So you look at the Tesla, it's a combination of image recognition with mapping technology, right? And really, so it's not there's no one technology that's AI. Machine learning is a concept that basically where you throw a ton of data at a computer and it mines that data and looks for patterns that the human mind can't recognize. So it basically does teach itself to iterate and learn as new data comes in. Right?
So as you described that, years ago, there was a famous case where a computer beat the world's best chess champion, and then more recently, the game Go.
Yep.
So is that machine learning, or is that AI, or is that a combination?
That is basically very narrow intelligence, artificial intelligence. That is likely machine learning. It is also probably some other terms I'm going to get wrong, but there's probability engines that they basically try to gauge behavior. Those type of things are math. And then the crazy thing about some of those stories. So the Kasparov being beat thing, funny story from there. He apparently got really messed up by this one move that he couldn't figure out why the computer did it. And it really messed with his head. Well, the programmers went back and looked at it, and it turned out that it was a mistake. So there's that. The Go situation was funny because, Facebook came out saying, we're going to have an AI in a couple of years that can win a Go. And then Google came out and said, oh, yeah, we haven't announced it yet. We did it last week. And then the funny thing is they came out with another version of that Go computer that beat the first Go computer hands down. And that first Go one was nuts because apparently it played a game that had never been played before. So it figured out how to play it in a way that humans hadn't. So that's interesting and frightening.
So tell me about the Wealthsimples of the world or the Betterments of the world, et cetera. So they're using a lot of machine learning or AI in their technology.
I don't know that that's the case too much. They're using a lot of algorithmic programming, right? So, in terms of when do you buy and sell things, when do you basically tax loss harvest? Those are all rule sets to be programmed. So algorithms are part of artificial intelligence, right? Because you can program things to behave a certain way. It doesn't iterate. It doesn't learn. Again, the key is for it to basically change its own programming to some degree so that it can improve upon itself. There's one robo-advisor in Canada that is using artificial intelligence to do active management rebalancing. Right. So I've yet to have them on the show, but they're booked. But I think the investing side of the world, there is definitely some plays I've seen that are looking at using AI to basically do fundamental research. I've seen that because, again, they can process data far faster than any of us could. The more interesting play for me, and I think the future is going to be, is financial planning is going to be really revolutionized by it. When you think about the amount of time that goes into a financial plan, a lot of it's data population, right? Well, so let's see, data aggregation, GDPR will help solve some of the stuff like that is going to help make that easier. In the US, they've already benefited from that in the likes of, Right Capital and eMoney, who really led the charge on data aggregation. And now Naviplan and others are basically launching data aggregation as well. So data collection is being reduced in terms of the amount of time spent, but then it comes down to how much time is the advisor spending tinkering? And yeah, we're using our training, we're imposing our views, but picture a financial planning AI system that literally just figures it out for you. Literally tests, optimizes everything. I mean,
it does a Monte Carlo simulation on a bunch of different
on tons of things, right? So we look at Monte Carlo simply as a methodology for testing different probability outcomes based on returns, right? But look at some of the other variables, right? Like, do you start taking money out of, registered accounts in Canada, qualified accounts in the US earlier than later? In the US, you have something called a 401k, Roth 401k rollover. Is there an optimal time to do that? You have situations whereby I look at all the time. We get people retiring early and they have very low tax rates. Right. Do we try to realize tax in those terms in order to in order to harvest those lower tax return rates? Well, all that sort of stuff. Like when you start, how do you optimize for Canada Pension Plan or Social Security? Mm-hmm. We have to tinker. We have rules. We have calculators. We have all that. It can test it a lot faster than we can. I mean, literally, the goal should be honestly for the financial plan to build itself with the AI. And I'm not trying to put myself and other people out of work, but that's the reality we're heading towards. And I think the financial planner still is there because there are going to be certain things in terms of the person's behavior and their psychology that we're going to be having to first and foremost audit and explain what happened and understand what happened and why and what the reasoning was. We can challenge it and test it to make sure it's right. And then delivery to the client, making sure that it fits their needs is still going to be of value to the clients. So I think that is still, as much as people think that we're going to automate the entire world away, the human aspect is still very difficult to automate away. However, again, if you saw the Google I/O demo of the Google Assistant booking appointments for restaurants and haircuts, man, I don't know. It is a little scary sometimes.
So it lends for a future of guaranteed income, right?
Yes, guaranteed basic income is an interesting one. We're not going to get into that one, but that's an experiment I hope to see done just so we can understand the ramifications of it.
Right, rather than just the test markets in Hamilton, et cetera.
Yeah, we're doing that in Ontario already. So,
right, yeah. So in the behemoth, the elephant in the room here.
Yeah,
is obviously blockchain.
Yeah, we're going to spend most of the time talking about this, aren't we?
So first of all, before you get into blockchain, I think there's still a lot of confusion as to what blockchain is versus cryptocurrencies. Yes. So why don't you spend some time talking about what blockchain is and the difference between blockchain and cryptos, and then we can get into some of the fundamentals of blockchain itself.
So let's go back to the origin, and then we'll get to blockchain, and then we'll go into cryptocurrencies. So back in 2008, when the world was falling apart, this white paper appeared online. And it was written by someone, quote unquote, claiming to be someone called Satoshi Nakamoto. Whether that is an actual real person or a group of people, it's hard to say because we don't really have much proof. And no one's ever stepped forward people have stepped forward, but no one's been able to prove it. The reality is that it was an interesting stroke of genius. And it proposed a alternative currency that was completely in the digital realm. So why was this revolutionary? Well, it was revolutionary because think about the internet. The internet is a one-to-many relationship. Right? Think about what happened with Napster. You could take a single audio file and it can be copied millions of times out there. There was no guarantee of ownership, right? So you can take anything on the internet, post a picture, and duplicates exist everywhere in no time. How do you, in that world, transact between parties and ensure that the dollar I'm spending with Guy is not being spent with Joe? Well, you can't. You couldn't, right? The only way you could do it. Difficult, yeah. Exactly. The only way you could do it was to trust an intermediary in the middle. And those intermediaries were the credit card companies and the banks, who charged princely sum for it, to be honest. So basically, that was the problem. That's why we always relied on those companies for it. Now, in 2008, everybody was annoyed with the financial institutions. And basically, the concept of fiat currency does not sit well with some people. And this concept of the Bitcoin paper came out. And it was really a breathtaking piece of computing know-how and also social engineering. So nowhere in that paper is a mention of blockchain. It actually mentions blocks, but the term blockchain was created afterwards. So let's talk about what the blockchain is. The blockchain is the underlying architecture of every crypto security that exists, or a cryptocurrency, whatever it is. And it is the technology or the code that basically is similar across the board. And when I say it's similar, You can modify these things. You can change and create all different ones. But the underlying theory of how it's all strung together is all the same. So what is a blockchain? Let's say I, Jason, send you, Guy, a Bitcoin or whatever it is. There's a transaction recorded, right? So who records this transaction? Well, this is pushed out to a network, and that network has various nodes. So lots of different people who are running their own computers who are basically keeping a record of every transaction occurring. This is what's known as an open ledger. It's a ledger that's distributed ledger. So it's basically distributed to multiple parties, right? So instead of going to one bank or one credit card company, it goes to multiple computers, right?
Everyone verifies.
Everybody gets a record of it. What happens with this data then? Well, what happens then is that transaction, along with several others, gets grouped into blocks. And basically, so I'm going to deal with enough transactions to fill this particular specific space. So I have, let's call it 10 transactions, for example, just as a hypothetical. Let's say every transaction forms a block. So what happens is that each of these individual computers, which are also known as miners, they would then basically work on finding a way to encrypt those transactions, the details of Jason sending transaction money to Guy and everybody else in the world doing the same thing. They're trying to find a way to encode that into a cryptographic piece. So what that means is that it's a block that is represented by all those transactions are represented by one long line of code. And that long line of code does two things. It transforms all the data that we had in those transactions, plus also references the block that came before it into one new block. So that line of code, basically what they're doing to create that is something called hashing. It is a cryptographic trick. Cryptographic means to encode things in code, like basically to make things coded so you can't just read them as is. So these computers do something called hashing in order to create the block. And in hashing, they create this it's basically a kind of brute force thing. You have to keep on just trying to randomly try to guess how to encode this until it reaches a certain line that has a certain value. I'm not going to do this, for the record, people. I'm not going to do blockchain full justice because it's very complicated. And trying to explain in simple terms is very difficult. And even some very, very bright people explain this very poorly. In fact, what I'm going to do is I'm going to link some episodes of different podcasts that do a really good job on this to the show notes. So as I was saying, this new block is created. This new block has all the data of our transactions, and it has a reference to the block that came before it. Right?
Hence the chain.
Exactly. So it creates a chain, right? All the way back to what's known as to the first block, what's known as the Genesis block. So every transaction that's ever occurred in that currency now is encoded on this chain. So if we need to audit that, that's fine. We can look on the block, uncode the block, and basically find that transaction. Now, what happens if someone tries to mess with that? So here's what happens. So all these different nodes basically do that. And then the first one who does it, who accomplishes it, pushes that information, that line of code out to the rest of the computers. The computers it takes a long time to create that code, but it takes very little time to verify that code. Right. So all the other computers basically look at it and say, yep, you know what? Your computer was the first one to basically generate that. Here's a coin in exchange for your work. Right. And then guess what? All of their ledgers add that block to the ledger. So now you have multiple copies, right? So you have multiple copies. So if someone messes with a single block, here's what happens. Let's say I want to change a transaction from Jason to Guy to Jason to Jane. And I go and I try to change that. The problem is you change the entire hash. You change that entire block. So you just basically ruined the entire. So now that next block, which references the block that our transaction happened in, it references nothing. It doesn't match, right? So the chain is broken. So that's the first piece of protection, is that breaking the chain creates an obvious break. So when that happens, a couple of things. The system knows something's wrong. There's a break. So it would try to verify the code with all the other blocks, with all the other ledgers. Right. The other ledger would be like, no, that code doesn't work. So it would just ignore that block and would continue on with the proper blocks. So essentially, there's an audit function built into the system. And the only real way to overrule it is to basically edit the same block in the amount of time it takes to generate a new block on 51% of all the computers. Right? So the more computers you have operating on this, the harder it is to hack. So basically what happens is, to sum it up, you have a transaction that gets a bunch of other transactions, creates a record that references, imagine a book, creates a book of records, but that book references the previous record. Right. The trick is that if you change anything in that book, it's going to change the reference to the previous record. So it breaks it.
I think you did actually a pretty good job explaining that, Jason.
That's pretty difficult. So basically now that is the blockchain. Now, why is this important? So let's talk about the currency aspect first. So now the double spend problem is solved. I can't spend the same dollar I spend with Guy that I do with Jane. Because if I give you the dollar, but then I try to give Jane the dollar, what happens? Well, the transaction tries to verify, and they verify that, sorry, Jason, you spent that dollar. That transaction is garbage.
Right. My understanding is this can be instantaneous as opposed to involving a bank or a credit card company that has to.
I wouldn't say instantaneous. There is time. I mean, especially
Bitcoin takes 10 minutes or something like that.
Yeah, Bitcoin takes about 10 minutes. You have some other ones like Lumens, I think, is down to like.
Well, Litecoin's
faster. Monero's faster. I think
Ripple.
Stellar's Lumens is down. Ripple's faster. Stellar's Ripple's down like a couple of seconds, right? So
it's not instantaneous, but it's ultra fast compared to transacting through a bank, which is a controlled ledger because they control the transaction and verify the transaction between two parties, right?
Exactly. But the problem is there. And so the good thing is that, hey, we've got this system whereby we don't have to, the best definition I heard of this is, guess what? We don't have to trust everybody anymore. Right? We don't have to trust you because now we can verify, right? And it's amazing how much of the financial system is built on trust, right? Like you even talk about how brokers settle transactions. It's like, okay, this transaction is settlable. We'll send you the security over the next 3 days. Like that's how it works. Like literally they have 3 days to deliver it, right? Yeah. So they're just trusting you that you actually have the security.
Yeah.
So now you don't have to trust because it's done very quickly. So
so talk about the currencies and then we can get into some of the implications in the financial world.
So why is this of interest? So here's the thing about this. You basically generate the currency or the coins that are generated in the generation of a crypto of a block. They're important for a couple of things. First of all, they incentivize the miners to actually do their job, right? They're getting paid in something. Now they're getting paid in essentially Chuck E. Cheese tokens, right? That's basically what it is, right? Yeah. It's like, here's a token. It's only worth something if people believe it's worth something, just like currency to some degree.
Just like gold.
Yeah. Exactly, right? So why the token's worth something? It's not so much that the tokens are worth something. It's that, let's just say I want to send anything to you. Let's still call it Canadian dollars, American dollars, whatever it is, right? Well, in order to transact on that chain and use that system to do it without a third-party intermediary and at a lower cost, then guess what? That token, I have to basically convert money into that token and then basically transfer that token to you, then you convert back. So essentially what I'm buying is the method, it's like a piece of paper, right? If the only way for us to exchange money was to use these special pieces of paper and basically like a check, for example, imagine a world where checks were limited, right? If checks were limited, then checks would have value themselves. So because these tokens are limited, that gives them inherent value because if I have to buy one before I do a transaction on it and you have to sell it, well, now there's a market for it in the middle, right? Now, this is attractive to people. This was originally conceived as solely a currency, right? So the question was, how do we create a currency online where people can't multiply it in perpetuity and we can trust transactions, right? And that's what Bitcoin solved. That's what Bitcoin did. It basically found a way for people to basically not double spend, to limit the amount of coins, and basically create a world where we can literally transact online with security.
And the implications there are you can send money across the world where before you'd need a
Western Union
or something like that.
Yep.
And now you can send money back to family back home. And it's just a matter of, like you said, exchanging your currency for the Bitcoin and they exchange it back into their local currency. But it can be done virtually instantaneously.
Yeah. And another piece of it is anonymity. So everything's sent to wallets. And these wallets have keys, right? Private keys and public keys. Your private key allows you access to your wallet and to your record. Your public key, on the other hand, is basically the one you give out to, it's like your mailing address.
Right.
Or your post office box, for lack of a better term, right? You have a post office box, only you can get into it with your private key, but people don't know where you live.
Fair enough.
In this case, people don't know who you are.
Right.
So that's the currency aspect.
Okay, so there's hundreds, if not thousands of currencies out there.
More every day.
Before we were talking last week and before I came in here today, I went on the Ethereum website and I created my own ICO.
Yeah,
right?
it's down.
It was that easy.
Now.
It basically took me about half an hour. I didn't launch it because I thought there might be industry regulations that I'd have to disclose.
The SEC is very much cracking down on stuff now.
It doesn't. There is no Guy coin out there yet, but I did go through the process. It's very easy right now to actually create your own coin because the code is public. Ethereum has a public site and you can just copy their code. So it's fascinating.
Yep.
But let's come back to, say, the blockchain. So now we've got cryptocurrencies are based on the blockchain technology, but blockchain has a lot more applications. So let's talk about maybe smart contracts and Ethereum and some of the other applications.
So Ethereum, which was created, which was project was led by a brilliant man by the name of Vitalik Buterin out of Toronto, basically realized that, hey, anything can be encoded on this chain, not just transactions. Yeah. We can encode contracts. We can encode anything that we can have an input and output for. We can encode that. So theoretically, you can basically create a blockchain for the transfer of real estate, for example. I want to sell my property. I will exchange that for X Bitcoin, and the registration is held on the blockchain. So theoretically, it's entirely possible for someone to transact anything in there. You can also create, like I said, contracts, like conditions. If you can code a condition, so say, for example, one of the things I talked to someone briefly about once was the idea of having blockchain around financial planning. Yeah. And the idea was an accountability blockchain, right? So every advisor's had the same experience where clients said, you told me I'd be at X by now, and I'm not. What happened between then? Was the performance? Was it that the advisor failed to do something? Was it that the client failed to contribute the money they were supposed to?
Or they took out.
Right? Or they took money out and forgot about it, right? Well, creating, again, imagine a situation where you create a financial plan or investment plan, whatever it is, you sign off on it, client stamps it as basically approved, and then now it's tied into their account. And the actions are monitored, and the violating party is basically called down on that, right? So what happens is that contract's violated. There's a record of that. You can create a new one to put yourself on a new path, but now you have an audit trail. Right? Whereas before, you have to someone had to take notes, and the other person had to remember.
So talking about the audit trail and real estate, like you raise a good point there, because if you have title on a property, right now there's title insurance.
Yep.
So you have to verify that you own the property and there's no liens against it. But if you have a blockchain transaction that verifies the legal exchange of the property,
as long as your private key is secure, then yes. Yeah, so it would be damn near impossible to get it out of there.
So what are the ramifications? Now I've heard there's devastating ramifications for the accounting industry. What are your thoughts on that for blockchain?
Oh yeah. So one of the biggest things that back offices have to do between banks and securities companies is reconciliation. So, we sent you X amount of money. You sent us Y. Wait a minute. It shouldn't have been that. It should have been that plus $10. And, trying to balance these things out. The fact that now there is a ledger that is distributed and equal pretty much at all times, right? Because 51% equals whatever the truth is. That eliminates the need for any kind of reconciliation department. That's the honest reality of it. And when you think about it, corollary is spreadsheets before the advent of, what became Excel, but what was VisiCalc back in the day. Yeah. Right before computerized spreadsheets, accounting departments used to have tons of people working on long sheets of paper with calculators and pencils. I mean, it's hard to imagine that now, but that was the reality. Yeah. The entire industry got put out of business almost overnight because of that.
It was called a spreadsheet for a reason, right?
Yeah, it was spread across the table, right? And they were huge, right? And they would cost a fortune to get done. Now it's like button clicks, formulas, everything, right? So that's anyone that's in a reconciliation type function, especially in the financial world, those are not jobs that are along for this world much longer.
Yeah, but even the bookkeeping jobs and even accounting, like I've talked to a few accountants who are very concerned about the next generation of accountants going through because, like you said, reconciling transactions, it's verified at the instant it's done. There's no need for people to be there. Yeah, the audit function starts to disappear. You still have to know where what transactions go into what category, whatever. But a lot of accounting firms, you look at the price for what's known as notice to reader in Canada, where no audit versus audit accounting, it's a big differential, and a lot of that's manpower hours. Well, if those manpower hours are not needed anymore, there's some of the cost gone. So what further implications do you see in the financial services industry? You talked about privacy before and the right to your own information. What about the anti-money laundering aspects? Yeah, that's an interesting one. So the thing is that people think Bitcoin's anonymous. It's not. The NSA and the CIA like to joke as they like to refer to it as prosecution futures. Basically, oh, wow, I have a history of every transaction that happened here. All I have to do is figure out who this public key is and who that public key is, and I will find the person. Now, that's not the easiest thing to do, but if money, and unless everything stayed online, the weakest point is when money enters the chain and when it exits the chain, right? So if you want to take it and convert it, your dollars and convert it into Bitcoin, there's a transaction that happens there. There's a record, and your name comes up to anti-money laundering. Coming out, exact same thing. Yeah. So yeah, it definitely makes it easier. I mean, that's why it basically was the tool of choice. Bitcoin was the tool of choice for a lot of drug dealers and cartels for a while, but those records exist. And that's the thing. And then, there's been rumors about, or been talk about some people figuring out how to crack the encryption pretty quickly. So I'm always surprised by people who think that something is going to be secure forever. That this doesn't make sense to me. So I think the bigger implications are the simple fact that this kind of technology, anything that underlies ownership or transactions, this is the future of all infrastructure. Like, this is it. Blockchain is the future of how we send money to each other, how we transact in securities. It is the future of anything having to do with an immutable record. So it's interesting to say that, because I've heard comments by people who are much smarter than me that suggests that blockchain is the next internet. It could be bigger than the internet in the way that it changes the way that we do things.
It's different and it's far less efficient. Right? I mean, like the total power consumption right now is equivalent to something in the neighborhood of the Czech Republic, just for Bitcoin. And the problem is that because you have so many computers doing so many things that are very power intensive, it's very, very inefficient. Is it going to be bigger than the internet? No, I think it's the next generation of the internet, but I think the internet doesn't go away. I mean, we're not going to replace TCP IP for looking at a website. We're not going to replace email with blockchain. There's no need for that. There's no need for every email you ever send to be stored in perpetuity on a blockchain. Like, again, right, to be forgotten, right? So is it going to be big? Yeah, it's going to be, we're at the ground floor of the next wave of the internet. We literally are in the we're in the mid to late 90s right now. But it's super early, and I see a lot of really bad ideas, and I see a lot of really good ideas, and God knows which one of them get to survive and become the next major companies. I have no idea.
Yeah, I find it all so fascinating. So that's all that I had on my list in terms of.
We're coming up to an hour, so we better stop there. Yeah. I did not do the greatest of job as describing Bitcoin. Guy, thank you for your decency in saying that I did. But like I said, I will link some podcasts in the show notes specifically. There's one on the Tim Ferriss podcast with Nick Szabo, who is one of the godfathers of cryptocurrency. And there was a series on Patrick O'Shaughnessy's Invest Like the Best called Hash Power. That was a fantastic job, and they will do an infinitely better job than I ever could. Hopefully this is enough to whet your appetite to check those out. So thank you for being guest host, Guy.
Thanks for having me, Jason. It's been fun.
Take care. So again, I did not do the greatest job on Bitcoin. I'm going to keep on beating myself up about that, but that's probably as good as I can get. With that, thanks again to Guy for being in and guest hosting. And if you enjoyed this podcast or the other episodes, which were probably better, by all means, leave a review on iTunes, Stitcher, Google Play, or wherever it is you get your podcasts. And feel free to email me. You can reach me at fintechimpact.co. Until next time, I'm Jason Pereira.
This podcast was brought to you by Woodgate Financial, an award-winning financial planning firm catering to high net worth individuals and their families. To learn more, go to woodgate.com. You can subscribe to this podcast on iTunes, Stitcher, and Google Play, or find more episodes at fintechimpact.co.